All right, we're going to look at part 2 of our split study. A little bit different case study here. What we're going to look at is a 50-year-old male, is dead this time. 2020 dividend rate with this particular company will be 5.65%. And we're going to mix up the funding. We're going to look at funding it up to the MEC limit, $50,000 per year for 7 years, and then $20,000 per year through year 20. And this comes from some consumers hearing from other agents that, hey, it makes sense to fund it heavily for 7 years, then drop the PUA rider and only pay the base premium. That's where you get your compounding. And that's why you want a 40-60 split, which you'll see is not the case here. But as we continue on here, what we're going to look at is the 40-60, which will reflect a $20K base premium and a $30,000 PUA. And then our 1090 will have a $5,000 base premium and a $45,000 PUA. It's going to be closer to 43.5 just because we do have a term rider here as well. Let's jump in. So, firstly, let's take a look at the 40-60. 50-year-old male, 5.65% dividend rate. Here's what I want to look at. Where's the money go? Here's my base premium. That's the 40%. And what happens here? Company does what? They overcharge me with this product only in the first year. So just about zero of that shows up in cash. Then I have my PUA allocation, the other 60%. All right. So as we look at this guy, like the last study, even though it's a different insurance company, you're going to see some consistencies here with this column. So if this company's dividend rate is what? 5.65. Guarantee is 4%. Oops, what this means is the surplus, the difference of 165 is what is reflected in this particular column here. And the higher the base premium, the more favorable this column will look. This will look, not necessarily this column. So the net cash value, that's our money column. That's what we're interested in. Break-even point. This column will help you track that. By year 7, I've paid in $350. I've got $350. Very common of a 40-60 split to see a break-even right around year 7. A lot of people who have been exposed to high cash value life insurance have seen that. It's almost become somewhat the standard or the norm. We're going to show you how to mimic big banks and corporations and get it much earlier than that. So that's our 40-60. When we take a look at the 1090, which again is just being aware of an insurance company limits and maxing everything out. There's our premium, 10%. There's our PUA allocation, the other 90%. There's a term cost, it's about $700 here. Main point though, to compare to the last example, we're going to look at the Excel comparison here in a second. Here's my dividend column. Lower than the last example I looked at with the 40-60 split. But what's your cash value? Do you have more or less? Here you go. More off the bat, breaking even year 4, more. So let's start to compare this long term. Here we go. 50-year-old male. Left, you've got the 40-60. Total outlay, $50K for 7 years. Then we drop the PUA rider and only pay in the base premium. We've seen this out there quite a bit, which is why we are modeling it. Now your dividend column, what do you have here? Year 1, nothing. Year 2, almost $5,600. Cash value, we already touched on this, takes 7 years to break even, about 30 grand right off the bat. So my base premium, that 20,000, did not show up in cash value. That's why I only have 30 initially. Now, let's compare that to the 1090. 5K base. Firstly, let's look at the dividend column. We'll back up 1 second. Funding's identical. So we paid in 50 for 7 years, and then we just dropped our total outlay. So if I'm a consumer, I don't care how the policy is structured as long as I don't trigger a MEC. I care about maximizing the cash, the flexibility, all that good stuff. So we kept the out-of-pocket identical in these two. So we dropped it after year 7, 220 to match exactly what was proposed over here. Now look at the difference in the dividends. Very similar to the last video. Which gives you more? 40-60 higher dividend. What gives you more cash? The net cash value. Up front, clear winner is the 1090. That'll always be the case too. The more money you have in PUAs, the more you're going to have up front. But then the question is, long term, which gives me more? If I'm thinking long range, cash value and death benefit, what's going to produce more cash value? Year 20 at the end of the funding. 851 with the 40-60, 922. 70K difference. If you want to look long range, let's look when he's 85 years old. About an $80,000 difference. That 40-60 at no point in time generates more cash. So if I'm looking at how to get more money short term and long term, look at the death benefits as well. So I've got more money left from a legacy planning on the 1090 long term as well. Beefs up my cash value. That's the name of the game. That's what we focus our education on, how to maximize the cash value. So in this case, 1090 split wins. Our next series, we're gonna look at, next video I should say, we're gonna look at the guarantees. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.